Well, greetings, Series 6 test takers. This is Kleck, and I'm coming to you from my studio in fabulous, colorful Colorado. And we've been making a series of videos, started by accident, well, unintentionally. You know, people were watching videos the night before or day before, morning of their exam, mostly in audio format during their commute to the exam site, if they had an hour commute. And I gave it some thought, and I thought, well, maybe we should just make a 60-minute overview flyover that they can kind of use as a warm-up, to kind of get them in their test-taking test-taking circadian rhythm. And we made the SIE in 60 minutes, and people have found it very helpful. So this is the Series 6 we're rolling out in 60 minutes. Now, if you're not testing tomorrow or this afternoon, make sure you save this. Just bookmark it, keep it somewhere safe, and come back to it when that time comes. This isn't really designed as a learning tool. It's just kind of to get you in the rhythm established. So anyway, let's get started with some of the things. I would just think of this as an intellectual inventory as you go down to take your Series 6. The key thing is if I bring up something, you don't know what it is, maybe research it and move forward. All right, let's start with talking about securities markets, investment securities, and economic factors. So as you should know, corporations capitalize themselves with two components. Equities. There's no such thing as a corporation that has not issued common stock. And then they might issue other things like preferred stock, bonds, or whatever the case may be. Now, in common stock, you know what you are as an owner of the business. You're an owner of the business and you have a right to vote on matters pertaining to the corporation. The main thing you'd be voting on, there's like mergers and acquisitions, but the main thing is we get to vote on the board of directors. And in the corporate charter, it'll either be cumulative or statutory voting. Statutory voting, if you have 500 shares, you have 500 votes. And if you're using cumulative voting and you have 500 shares and you're voting on 3 board seats, you would have 1,500 votes. And, we have cumulative voting. That protects the minority shareholders more because for any one board seat or one thing, they could have greater impact. Now, as an existing shareholder, you have the right to maintain your proportionate ownership in the corporation. That's called your preemptive right. And the way corporations do that is they make a rights offering to their existing shareholders. They say, we're selling more common stock. Would you like to buy the proportion necessary to maintain what is your current proportionate ownership in the company? It makes sense. That's very important. Rights are short-term because the corporation needs the money. They need it now. If they can raise it from their existing shareholders, they can pass on the savings to you. They won't have to hire an investment bank. So typically rights are short-term and they're exercisable below the current market price. Another type of potential equity security, because when people exercise rights or they exercise warrants, what they're buying is common stock. So in warrants, corporations use warrants primarily as an incentive to get you invested in another security like a bond, typically a bond sweetener. Warrants would be long-term and they would be exercisable above the current market price. Now, some companies pay dividends, some companies do not. If it's a corporation that pays a dividend, we would expect that to be more of a mature, stable business, and they would have a board get together and say, okay, let's declare a dividend distribution to our shareholders as of record. So that'd be a record date. And then there's the declared date, which is when they had the meeting and declared it. And they say, your shareholder as of records, they make one up September 16th, you get the dividend. And their payable day is when they actually write the check. Now the X date is the day before the record date when we're talking about a secondary market. So the X date is the first day that the dividend at the stock trades without the dividend being attached, and it trades one day prior to record. Now, remember, in an open-end fund, you're doing business directly with the fund. That is not a secondary transaction. So in an open-end fund, all the dates, declared date, record date, X date, are set by the board of directors. In secondary trading, the X date is a function of the Uniform Practice Code, how we standardize practices within the secondary the secondary markets in the securities industry. Now, it's very important. Selling dividends is a big no-no. That's anytime that I'm using the artificial sense of urgency to get you to buy a stock, whether it's a stock or whatnot. Another right you have as shareholders is if you liquidate the business, the corporation, you have a residual claim. So theoretically, if we sold off the assets, we paid off the liabilities, and there's money left over, you as a shareholder would be entitled to your prorated share of that. Theoretically, refer to that value as book value. Par value is an arbitrary number to set up the books. 1,000 for bonds, 100 for preferred stock. Common's $1. I wouldn't worry about that. Market value is that supply and demand relationship. That book value represents residual claim. Corporations may choose to issue preferred stock. These are the ideas that mutual funds will own within their portfolio, perhaps. And then the preferred stock category, remember, is called preferred stock because when you own preferred stock, you have preferential treatment in two areas. Dividends. The corporation cannot pay a dividend until it pays dividends to its common shareholders. And we have preferential treatment in liquidation, which is why it's called preferred stock. In the preferred stock category, we have cumulative, where if the corporation misses a dividend, it goes into arrears. We have straight preferred, where if the company misses a dividend, there is no going to arrears. Just try never better next time. We have convertible preferreds and convertible bonds, but I wouldn't worry too much about that. But this allows the conferred stock or bondholder, whatever the case may be, to convert their bond, switch their status from being a preferred stockholder or bondholder to owning common stock. Those terms are set out based on par. That's called the conversion price. So we take par, we divide by the conversion price. We would find out, what the conversion ratio is. Now, if anybody ever asks you about economics or finance or investments, you want to sound smart, you should say it has a lot to do with interest rates. And corporations want to be able to replace high-cost financing with lower-cost financing. So when interest rates come down, it's more likely that the corporation is going to call away its preferred stock. It's going to call it away and reissue preferred stock at a lower price, right? When interest rates fall, expect to call. Same for bonds. When preferred stock price bonds are typically callable, the call risk is associated with a declining interest rate environment. We have American depository receipts, foreign securities trading in domestic markets. You should definitely know that. That's what that is. And then the second thing is you have currency risk, which is the underlying business risk conducted in the foreign currency. So you have foreign currency risk. Now, I wouldn't worry too much about options, derivative investments on your Series 6. But, some mutual funds are allowed to use options within their strategies. And we have two types of contracts, calls and puts. You can either buy them or sell them. So we have 4 basic options positions. And some portfolios managers, mutual funds, are allowed to write covered calls, short or sell calls against the securities in the portfolio. And that would mean that the bond might have a higher yield because of the income from selling the options contract than other, portfolios, all things being equal. Now, if they're going to be allowed to do covered call, that has to be in the prospectus. Now, the disadvantage is they don't participate past the strike price. And again, some fund managers might buy calls, establish the choice to buy stock because maybe they're expecting to see some more contributions coming into the fund. They want to lock in that price. And then other funds are allowed to use options to hedge, where they can buy a put on the index and most closely approximates their portfolio if they're worried about systematic risk, or buy a put on individual selection within the portfolio to hedge. So again, I think, maybe 1-2 questions on this. Tell me you missed your mark on your 6 because of options. I'm going to say, I think you have other problems. All right, so in terms of debt securities, we have 3 issuers, right? We have corporate issuers, we have municipal issuers, and we have U.S. governments, which are all issuers of debt of denominated securities. And in the corporate category, debt securities issued by corporations, we have secured bonds, we have unsecured bonds. Secured bonds have collateral, right? So we have mortgage bonds secured by real property. We have equipment trust certificates secured by marketable securities placed in escrow. We have equipment trust certificates, which is secured by physical, real, movable equipment. And in the unsecured category, we have debentures and we have subordinated debentures. And one thing you need to be able to do is rank the securities we talked about earlier in liquidation from senior to junior. So if a corporation liquidates, the most senior person in line to get their money are the secured bondholders, then the unsecured bondholders, the preferred stockholders, then the common. That would be senior to junior. Junior to senior would be the opposite: common, preferred, unsecured, secured. So I would definitely know that. You should be prepared today or tomorrow to do current yield. You know what an investment pays you divided by the current market price, what it costs you. In a stock, that'd be annual dividend. The bond, it would be the annual interest. So if it's an 8% bond, for example, it's based on par, that's $80. You would divide that by the market price, and that would be the current yield. And how most people would not be interested in a bond buyer in the current yield, they'd be more interested in what they make by holding the bond to maturity. So the yield to maturity, if you buy the bond at a discount, is going to be the highest yield you could expect. If you buy it at a premium, it'd be the lowest yield you could expect. We have zero coupon bonds by issuers. Zero coupon bonds, zero coupon, no income stream. Sometimes referred to as original issue discount bonds. And you should know that zero coupon bonds are good for somebody who has a target date investment, somebody who needs a set sum of money at some future date. You should know that as you hold the bond towards maturity, you have to do what's called straight line amortization upward, called accretion. And that imputed interest you're receiving is taxable. So sometimes we refer to that as phantom income, because you're paying income on taxes, that money you're not actually receiving. Zero coupon bonds have that feature. All right, so in terms of government bonds, we have T-bills, which are issued at a discount. We have 2 to 10 years. We have treasury bonds that are greater than 10 years. We have government-sponsored enterprises. We have GNMA, Fannie Mae, and Freddie Mac, are where the fund manager might be buying proportionate ownership at a pool of mortgages. There's many different types of securities, that's how many different types of mutual funds there are, right? And so if we are Ginnie Mae, unlike others, pays interest in principal monthly. It's unlike the others, directly backed by the U.S. Treasury, and it's fully taxable. The Treasury securities are taxed. The U.S. government, the U.S. Treasury, Canada will tax, but not the state. U.S. government sponsorship enterprises like Ginnie Mae, they're fully taxable. All right. So there's 2 types of municipal securities. There's general obligations that's backed by the taxing authority of the municipality, and revenue bonds backed by user fees. I'm kind of, thinking about this. I like to look in an airport and look for a sign that says, your taxpayer dollars are not at work. So, as a taxpayer, you are not financing revenue bonds. The user fees are, if it's a school district or something like that, it's going to be financed through a GO. Now, in terms of suitability, remember, you're going to have many bond funds, tax-free bond funds that own many bonds. So you need to be able to tell the customer whether they should buy a corporate taxable bond fund or a muni tax-free bond fund. And the way you're going to do that is by knowing the taxable equivalent yield. If you don't know that, it's too late now, but you take the taxable yield times 100% minus the tax bracket, multiply if we start with a taxable bond, we divide if we start with a muni, tax-free, divided by 100% minus the tax bracket. There is a type of revenue bond that is subject to the alternative minimum tax, and that is an industrial development revenue bond, an IDR, or sometimes referred to as an IDA. So if my customer is subject to EMT, we want to make sure that we avoid funds that will be holding these. Money market securities. Money market securities would be T-bills, nothing better than a T-bill. Money market securities are high quality debt maturing in 12 months or less. But besides T-bill, there's also bankers' acceptances, or BAs, that are used to facilitate foreign trade, issued at a discount, maximum maturity, 270 days. Commercial paper issued at a discount, max maturity, 270 days. That's secured borrowing by corporations. Negotiable CDs, jumbo CDs. Again, on the test, there's a parking spot for customers' idle money. Would be a money market fund or a money market mutual fund, right? So either a traditional bank account or a money market mutual fund. Economic basics, very basic. We have physical policy, government spending, and taxation controlled by Congress and the president. We have monetary policy, that's the money supply. That's controlled by the Federal Reserve Board. And there are some interest rates that you're held accountable for, as I mentioned earlier. You want to sound smart. Somebody asks you about economics and finance or investments, and say it has a lot to do with interest rates. So one thing that the Federal Reserve Board does is tell banks how much they have to keep on reserve to meet their everyday demand for money. Bank, it's called the reserve requirements. And if I don't bank with excess reserves, I get, I lend to the bank with the deficient reserves. That's called Fed funds. Fed funds is the most volatile of all interest rates. If it's excess lending to banks in deficient reserves. Fed fund rate. That's set by the Fed. That's the only interest rate set by the Fed. And remember, the most common tool the Fed uses to control interest rates, their dual mandate is price stability and full employment is the open market operations of the Fed. So the Fed buys and sells government securities. Too much money chasing too few goods is bad. That's inflation. And inflation is measured by the Consumer Price Index. So the Consumer Price Index is a price of assets and services in a particular city, and that's how we measure inflation. Two more interest rates you should know about is prime rate, banks to its best commercial customers, and broker call, which is used to finance margin accounts. That's banks to broker dealers. Currency rates. So currencies have an inverse relationship. So it's meaningless for me to say that the dollar is strong unless I tell you in relationship to what. Right now, this dollar is strong because interest rates are in the U.S. are attracting more money, and that means the interest rate is strong. That means our dollars is buy more foreign goods. So imports become more competitive and exports become less competitive. All right, so if you want to start your own mutual fund, I don't know why you would. There's more mutual funds out there than there are McDonald's. There are actually more mutual funds out there than are all securities put together. But if you want to start a mutual fund, you would have to comply with the Investment Company Act of 1940. And on the Investment Company Act of 1940, you would have to classify yourself as either a face amount certificate company. Now, again, if that comes up, it's going to be very low probability, but sometimes we refer to those as contractual plans. Now, contractual plans have a 9% maximum load, something that these are used as funding vehicle that's embedded into a variable life policy. But anyway, I wouldn't worry too much about that on the 99%. I know there's a free look on that type of transaction of 45 days. Now, you can classify yourself as a unit investment trust where we have passive management. The asset are professionally selected, but then there's passive management. The ones we care most about as test takers on the Series 6 is open-end funds and closed-end funds. And you want to be able to contrast an open-end fund and a closed-end fund. Now on your Series 6, you're getting what's called limited registration, and you're allowed to sell mutual funds with a prospectus in the primary market. And the major distinction between open-end funds and closed-end funds is open-end funds, as I mentioned, every share is a new share. In an open-end fund, they're continuously offering new shares to the public. We not only have to comply with, the 1933 Act, you also have to comply with 40. We have to combine with 33. Closed-end fund is a one-time offering and trades supply and demand. It's kind of an interesting offering. So there would be, IPO, there would be a perspective. But, if you get somebody involved in a closed-end fund, you get something involved with the perspectives of the primary market. All right, so a mutual fund under the Investment Company Act of 1940 has the BN operations of at least $100,000 and 100 shareholders. And if we want to borrow money, not to purchase securities, but to meet redemption requests for every $3 in assets, we can borrow a dollar. It has to have the mutual fund. It has to have a clearly defined investment objective, because what we're trying to do is match the investment objective of the fund with that of the potential customer. We have potential promotional expenses. Now, promotional expenses are not paid by the investor. On an A share, for example, that's a front-end load. So this is a promotional expense paid by the fund. And 12b1 fees required to be implemented require a majority vote of the disinterested board. And remember, you have to have at least 40% of the board members of that fund that are disinterested, that are representing the public. So we're hoping that if we're doing something we shouldn't, or it's not in the best interest of the shareholders, at least those board of directors, that's called our outside board of directors, our unaffiliated board members, would hopefully say something. So we're going to have to know who does what. So typically the largest expense of the mutual fund is the investment advisor fee. Remember, be careful. Read the full question. This afternoon or tomorrow, make sure you're reading the full question. If I asked what is the single largest expense of a mutual fund shareholder, that would be the load, the sales charge. I didn't ask that. The largest single expense to the mutual fund is the investment advisor who is making decisions buying and selling securities. So if we have custody, yep, the money and securities are still here. We have a transfer agent. Be careful. He redeems old shares and issues new shares. Remember, redemption right is not this idea that there's somebody else taking your spot in the fund. No, no, no. We have to calculate the NAV, net asset value, at least once per business day. The NAV plus the sales charge equals the public offering price. And the most that could be is 8.5%. And if we're charging somebody 8.5%, we've got to give them breakpoints and letter of intents and all that kind of stuff, which we'll talk about. The expense ratio is how much of the money gets eaten up with the people and the folks we just talked about, right? So, it's not the only comparison, but a fund with a lower expense ratio is leaner and meaner than perhaps another fund. So mutual fund share classes. We have Class A shares. Now, Class A shares have that front-end load, and that's, the kind of judicial kind of thing. And a Class A would be appropriate for somebody who has a large sum of money and who's long-term. We have Class B shares for people who maybe have lower amounts of money but are still long-term. The Class B share is going to have a contingent deferred sales charge. And that means, if they stay in long enough, we'll waive that. But make sure on the test you don't misuse no load terminology. Right? So I don't describe Class B shares as no load. No. It has a contingent deferred sales charge. Class C shares have a level load. And if we have a 12B1 fee, we can charge up to 0.25% and still refer to ourselves as a no-load fund. If we go past promotional expense, marketing, advertising, paying people to sell the fund, if we go past that 1%, we can't refer to ourselves as a no-load fund. And over the life, we can't have more than 0.75%. So 12B1 fee, promotional expense up to 1%. 0.25% or 25 basis points. You can't refer to yourself as a no-load fund. You can't go past 0.75%. So mutual fund redemption, when you come into the fund, get out of the fund, it's always done on the calculation of the next NAV. That's called forward pricing. That's always based on the next, calculation of the net asset value. Now, if you've been dollar cost averaging, dollar cost averaging is where you give me fixed dollars invested regularly. And the neat thing about dollar cost averaging is you'll be doing exactly what you should be doing, is buying more shares when they're low and less shares when they're high. That's exactly what you should be doing. The average cost per share being less than the average price per share. And if you want to redeem, I say, well, listen, what shares do you want to do? Now, most of us would like, if we're not going to redeem all of our shares, would probably want to redeem the shares that we have the highest cost basis on, because that would generate the lowest tax. And that's called share identification. If we're looking at all of them, we could do average share, but it's important on the test, if we can't do share identification, we have goods and record. If we're not doing average cost, the IRS is going to oppose on us FIFO. First in, first out. First shares in, first shares out. So if you're struggling with a tax question on your Series 6, always pick what yields the lowest for the U.S. Treasury. Now, mutual funds are managing public money, so they're not allowed to engage in aggressive investment strategies like margin, short sales, like naked options. Mutual funds, we're trying to match, remember, the investment objective of the customer. I mentioned there's many different types of investments we have. That's how many different types of funds we have. We have annuities. We have variable annuities. I think of a variable annuity as a mutual fund with an insurance wrapper. And a variable annuity, you're using after-tax money, so that's going to represent your cost basis. So that's what you're putting in the variable annuity, and then that's going to grow tax-deferred. And then when you're 59 and a half, you can choose to do a random withdrawal, a sum. You can annuitize. You have a lot of choices. If you do a random withdrawal, it's going to be LIFO. Last money in, first money out. Last in, first out. If you do a random withdrawal. If you do a lump sum, then what you owe taxes on is the difference between the cost basis, because remember, that was your after-tax money. and what you have now, and it's going to be taxed at ordinary income. Now, a nifty thing you can do is you can annuitize and turn the variable annuity lump sum into an income stream that you can outlive. Now, you have some choices, and the choice that will give you the largest monthly payment is life only. So life only gets you the largest monthly payment. I say, hey, when you get your check, give me a call, because your check is going to go up or down based on the assumed interest rate. You know, we have an assumed interest rate. We won't be an insurance company long. We don't assume numbers don't play out the law of large numbers. You say, okay, Colin, I got $4,000. And I say, okay, $4,000 is money coming back to you. That's called the exclusion ratio. And your check is going to go up or down or remain the same based on the assumed interest rate, the AIR. So if we get more than the error, the check goes up. The check goes up. We get less than the error, the check goes down. If we get the error, the check stays the same. Now be careful on your exam this afternoon or tomorrow that you don't fall prey to getting hung up on the numbers. It doesn't matter if the error is 4, 4.1, or 30%. As long as it's over 4%, check goes up. Don't get hung up. If I tell you the error is 4, it doesn't matter if it's how much less than it. Less than 4, it doesn't matter. The check goes down. By the way, when we do that, we turn the accumulation units into annuity units. What I mean by that is, when you're in retirement, you're $4,000 to $4,020, $4,040, $4,015. So it's going to be bouncing in a big way. We have variable life insurance. Variable life insurance, remember, is a kind of a hybrid where we have some money that is going into the separate account. The mutual fund, that's what that sub-account or separate account represents, is a mutual fund, an underlying mutual fund, right? So, a lot of the time these questions are actually camouflaged as mutual fund questions. So what I mean by that is if I have 6,000 accumulation units in a variable annuity, intellectually that's no different than saying I have 6,000 shares of a mutual fund. That's kind of what's going on. So sometimes we get an annuity question, just make sure and you say, are they trying to trick me into one of those camouflage questions? But some of the money, the idea of a variable life is that at some point we may have enough in the separate account to sustain the cost of insurance. And it's very testable. We don't ever sell life insurance as an investment product. We sell life insurance as life insurance. And the death benefit will go up or down based on what's going on with the separate account, right? So it's calculated, the death benefit in the variable life policy is calculated annually. The cash value is computed monthly. And it's based on the actual earnings, not the assumed interest rate. You can go from one policy to another. There's what's called a 1035 exchange. You can go annuity to annuity, life insurance to life insurance, but you can't go from an annuity to life insurance. So you have life settlements. That's where you do a viatical and you settle in the secondary market and you sell in the secondary market. I wouldn't worry too much about that. The sale of a life percentage policy, but it's called a viatical. All right, securities and tax regulations. We have 1933. We talked about that. That's a Prospectus Act, the first market. 1934, which created the SEC. All right, so as long as you can cover up the screen and ask yourself, are they asking about the first act, 1933, or the second act, which 1934 governs a secondary market, right? So we have FINRA in 33 has primary jurisdiction of enforcement on the domestic securities laws in the United States of America. And FINRA is the self-regulatory organization for the securities industry. We have the Federal Reserve Board, which is the regulator for banks, as well as the Federal Reserve Board, which establishes the rules about credit extension from broker-dealers to customers. That's called Reg D, or Reg T. And that's one thing Reg T says, is that securities can't be purchased on margin or new issues. And new and funds are considered new shares. So yeah, open-end funds on margin, not happening. 33 guy says the Prospectus Act, we're going to make our registration statement. And once we have our registration statement saying we're going to sell brand new securities to the public, we do what's called a cooling off period, a quiet time, which is a minimum of 20 days. What I can do during the cooling off period is I can send you a preliminary prospectus known as a red herring, which is pretty much everything you need to know except that except the price, which is important. I can take indications of interest to a key point. I can take indication of interest. I could place a tombstone ad, where the effective date is when we actually have gone public. Now, whether it's a fund or not, or it's a stock, and we're doing this, we're supposed to be doing due diligence, making sure all the information we're offering to investors is accurate, truthful, and relevant, not false and misleading. You're going to have an underwriter who helps you through the process as an issuer. And, the underwriter is going to sign up people as members of the selling group. By the way, this is very much how the mutual funds are done, right? So you as a Series 6 have what's called an approved product list. The approved product list is the funds that you can sell. It's as a baby broker, you might want to say, where's our approved product list? Who knows? Maybe it's Franklin funds, American funds, all the funds you can get people involved if you have a selling agreement, which you are as you're a member of Franklin Templeton Fund Distributors. Remember, their selling group. You go out and try to sell the funds, right? Remember, so you can't give concession discounts, allowances to you or people who aren't registered. But some funds will allow you as a Series 6 to write the NEV, and that's fine. The main thing for us to buy that relates to us when it relates to a fund distributor as an underwriter, sponsor distributor, is the maximum gift of gratuity to an associated person of a FINRA member firm, the fund distributor, can give to the associated person of another broker-dealer, your firm, in the selling group. I'm assuming watching this, you're not an inside wholesaler of Franklin Templeton, but assuming most of you are going to be selling mutual funds to retail customers. That's what the test assumes anyways. Remember, that's $100. A lot of us would never make it in our career without our wholesalers. He says, Colin, why don't you invest your prospects and clients to a seminar this evening? I'll come talk to them about professional management, diversification, and ease of ownership. I'll pay for the pizzas and the sodas, not a problem. So this rule doesn't apply to normal deductible business activities. And this rule does not apply to reminder advertising. Shot skis, I had an umbrella one time. And it was beautiful. Someone asked me, where'd you get that? I said, well, I got it from my wholesaler. I'm just kidding. All right. So 34 says you're going to have supervision of associated persons. So you're a supervisor. If you're supervising Series 6s, registered representatives, you're either going to have a Series 24 or a Series 26. Series 26 only allows you to supervise people selling prospectus. Series 24 is a general securities principle. Who knows? Maybe we'll see you in one of those classes. So people and places, there's two major market centers in the secondary market is the New York Stock Exchange and NASDAQ, National Association of Securities Dealers Automated Quotation System. I would know that the New York Stock Exchange is an auction-driven order market. That's where they're matching buyer and sellers. And I would know that NASDAQ is an over-the-counter market. There's others, but that's the major one. And over-the-counter markets are best categorized as negotiated and quote-driven markets. We also have the third market, which is listed securities traded over-the-counter. We have fourth market, which is direct trading between institutions. And the over-the-counter market, we have what are called dealers or market makers who post their quote, their bid and their ask price. They say they're willing to buy their security into their inventory, and they list the price at what they're willing to sell it out of the inventory, the bid and the ask. And the customer is only looking at two prices. He's going to pay the high price, the asking price, and the customer will receive the bid price, the low price. It's called the spread. When do trades in secondary market settle? Regular way settlement, uniform practice code of FINRA is T+2. So trade date is when we agree to the terms, sign the contract. The second business day is when ownership changes hands. Now, we don't tell customers this because we don't want to use our money to settle their trades, but the Federal Reserve Board says customers actually get 2 additional days to pay for their transactions on the secondary market. So they basically get T+2+2. They actually get T+4 technically. That's for corporates and munis only. Taxation, I wouldn't worry about your income tax, except that, remember, it would be important to know your tax bracket in terms of figuring out whether you should be in a taxable bond fund or a tax-free bond fund. Capital gains distributions is when we sell securities. Now, whether the fund sells the securities, the fund manager, or you sell the securities, you have individual investments. To qualify for a long-term capital gain, you have to be at risk for more than 12 months or 1 year. And if you're not at risk for more than 12 months, it's going to be a short-term capital gain. And the idea is that short-term capital gains are going to be taxed at your ordinary income tax rate, whereas long-term capital gains qualify for lower rates. So it's a little more tax efficient if it's longer term. Now, I can take losses from my investments against my earned income, me working for money. So I'm, you know, worked really, really hard to become a broker, worked for a lot of years to do this. So we put together probably the most unparalleled learning platform, the best personal finance education you could receive on our, university. But let's say, I was earning whatever we're earning from our side of the business on that, let's say my income was $3,000, which is $47,000. I could take $3,000 against that earned income. So be careful here. There's two scenarios on the test. There's two scenarios. There's a, Colin, I'm a living, breathing human being walking planet Earth, and I gift my stock to my nephew. So I buy 1,000 shares of Apple today at $153,000, and I give that to my nephew, and he assumes my cost basis, which is 153 this year. Now, if I die and I don't gift it to him, but it's part of my estate, and it's a transfer to him as an heir, and I'm dead, so there's going to be a difference. It's going to be a step up in the basis. So let's say Apple's 200 when I die. So now his cost basis is 200. So two scenarios there. I'd have a general understanding of retirement plans. Big time, I'd kind of know the big numbers, 59 and a half. If you choose to draw down, early, you'd have a 10% early. I know if you do a rollover, you'd have a 60 days to get it back in the same type of fund family. I'd know you have to do required minimum distributions at 72 unless it's a Roth IRA, which with a Roth, you can have tax-free withdrawals and there's no RMD of your investment. You're not using pre-tax, money. I'd contrast a Coverdell education savings account with a 529. A 529 is a better deal on the test anyway. It's not. It means that there's a lot more money in it, but it comes up the winner. Instead of 2,000, it's level with 5 years and do not pay the gift tax. I remember in a 529 category, we also have prepaid plans where again the question would just be, if you get a bachelor's degree, am I doing so by a good inflation hedge? I'd understand the general understanding of ERISA, the Employee Retirement Income Securities Act. I would know about TSAs, tax sheltered annuities, TSAs. And the test question here would be to make sure you know who qualifies for a TSA. It would be employees of education establishments, schools, 403B, or 403Bs of educational institutions or employees of 501c charitable nonprofit organizations. I would know the difference between a defined benefit plan, where the employer assumes the investment risk, and a defined contribution plan, where the employee assumes the investment risk. The one most people are familiar with is a 401k. I will have a general understanding of the Investment Advisor Act of 1940. If I'm going to give investment advice and I tell people I'm in the business of giving investment advice and I want compensation, I'm going to have to be an investment advisor. Now, some of you, after you pass your 6, you may be taking a 63 and a 65. And the reason you're taking a 65 is to be an investment advisor representative affiliated with, being able to make fees as well as transactions commissions. So, right now, the way it works, right, if you're just getting a 663, I would say, listen, you got to buy a mutual fund. You say, what are you for that advice? I say nothing. You say, well, how do I get one? Well, you get one from me. I have a 6, I can get you involved. I would have a general understanding of that. SIPC, I would have general understanding. By the way, you don't have to be an investment advisor if I'm giving you advice is free and I'm being paid on transactions. Anyway, SIPC, I would know the max coverage is $500,000, which no more of $250 can be cash per separate customer. Every account that have different beneficial ownership. I would be aware that the Insider Trading Act of 1988, I would know that it's triple damages or treble damages. So if I make $9 million, I owe $27 million. I would know that it's also not only civil, it's criminal. The criminal penalty is up to 20 years. I would know Regulation SP, that we have an obligation as a financial institution to protect the privacy of our customers. And if we want to use the information to cross the list of the customer, we need to have their permission. I'll never disclose information without your consent, right? Can I tell somebody I manage money for you? All right, so prospecting and communications. There's three types of prospecting on your exam. There's institutional communication. I wouldn't worry too much at all about serious success taker. Retail communications, which I would. Retail communications are for more than 25 persons in a 30-day period. So 25 retail persons, more than 25 retail persons. Now the TWES question, if it's more than 25 retail communications, sent out in an email, it has to be approved pre-distribution by the principal. If it's correspondence, that's kind of our third bucket. Institutional, who cares? Retail communication, more than 25. Approval, pre-distribution from the principal. Correspondence, 25 or fewer. And there the principal can approve it pre or post-distribution. It's really the principal's decision on how to go about that. We file retail communication with FINRA. If we're a first-year firm, we file it 10 days prior to first use. If we're an established firm, we file it 10 days after first use. When selling mutual funds, particularly, as we said, A shares, we have breakpoints. Be careful, again, read the full question. Breakpoints are good. A breakpoint is a quantity discount. It's a good thing. A breakpoint sale is a violation. It's a bad thing. That's when we try and maximize our commission by avoiding letting the customer know about an upcoming breakpoint. If they invested this much more money, they're going to hit a breakpoint and get a lower sales charge. Breakpoints are bad. So, you say, Colin, for my initial investment, I don't have enough to qualify for the reduced sales charge. The easy way to stay out of trouble here is how to get the best deal. So I say, well, why don't we fill out a letter of intent? The letter of intent is good for 13 months. And there's no way you can be hurt filling out a letter of intent. It's a unilateral contract. It's only binding on the mutual fund, not binding on the customer. So you get your 6, you're properly registered, you're effective, you have a nice ticket, and let's say the breakpoint is $100,000 or more. And I'm looking at your application as your supervisor, and wow, good job, $80,000. Good job. Did you tell them about the breakpoint? Oh man, I got so excited, I forgot. Good news, the letter of intent can be backdated 90 days. It could be backdated 90 days. Now, rights of accumulation are different, right? So customer says, Colin, there's no way I'm coming up with the money. I say, well, let's at least get you rights of accumulation. With rights of accumulation, there's no time limit, but you don't get the reduced sales charge up front. You get it when you cross that threshold. When you cross the break point on that and all subsequent investments, you get the reduced sales charge. Investment clubs cannot pool their purchases for meeting the breakpoint, so no breakpoints for investment clubs. And we said the maximum sales charge is 8.5% for mutual funds. Okay, so types of accounts that we have. How do we register the account? We have individual accounts. That's pretty straightforward. We have transfer on death accounts, which allows transfer on death to transfer the assets without probate. So transfer on death allows the account to be transferred and avoid probate. We have joint accounts, very testable. Customer accounts is very testable. So I know some of you have already took your SIE and there's some overlap here, but you have to be able to contrast joint tenants with rights or survivorship with tenants in common. So with joint tenants, rights or survivorship, both parties own the account. There's no fractional interest, and the decedent's share goes to their estate. With tenants in common, there is a fractional interest, 50-50, 80-20, look at a pie chart, right? Whatever the case may be. And the decedent's share goes to their estate or beneficiary. So again, very testable. We have Uniform Gift to Minors Act, and we have Uniform Transfer to Minors Act. And again, we should be able to know about this, and it is very testable. High probability. So one minor, one custodian per account, no margin. The kid's tax ID number goes on the account. The distinction with a Uniform Gift to Minors Act account is we re-register at age of majority, 18 or 21, depending on the state. With the Uniform Transfer to Minors Act, we register, we can stipulate up to the age of 25. Corporate accounts, we need a copy of a corporate resolution saying which corporate officer can trade the account, right? When you need a copy of the corporate charter, if you want to see what specifically is permitted, I don't think it'd be a big deal in mutual funds. But if it's a partnership, again, we're going to need a partnership resolution and perhaps the partnership agreement. to make sure whatever they're doing is acceptable based on either corporate charter, if it's a corporation, or a partnership agreement, if it's a partnership. Discretionary account, what constitutes taking discretion? If I, as a rep, am making a decision about action on whether to buy or sell, asset, which security to buy or sell, amount, the quantity, I need to have a discretionary authority on your account. I do not need discretionary authority on your account to make a decision about time and price. So, if you say liquidate $10,000 of the Acme fund, liquidate $10,000 of the Acme, the 3As are present. Do whatever time and price you think is right. But if I say, I know I have more than one mutual fund, sell whatever one you think I should redeem, that's unacceptable. That would require discretionary authority. Now, if we have power of attorney or trading authorization, we have two. We have limited trading authorization, limited power of attorney, where all I can do is make decisions about investments, and I have full trading authorization, where I can only make decisions about investments, transactions. I can withdraw monies and securities. That would be a bigger supervisory challenge. We talked about, hinted, some violations of the Code of Conduct. The Code of Conduct is the ethical behavior that associated persons of broker-dealers and broker-dealers of customers. And under the Code of Conduct, we said, no selling dividends, no breakpoint sales. These are the conduct rules. You can receive continuing commissions from a rep who's retired as long as there's a written contract, right? So continuing commissions with a written contract for somebody who was registered and is no longer registered. You need to get prior written notification or give prior written notification to your firm for outside business activities. If you're going to get people involved in investments not sponsored by your broker-dealer, again, you need to make written notice, because if you don't make written notice and they like to determine whether there's an adverse interest, that's called test question, selling away. So if they say on the exam, an associated person sells an investment not sponsored by their employer or broker-dealer without notification, and amounts with a permission, this is a prohibited practice known as selling away. If you're opening an account at another firm, Firm A is going to make written notice to Firm B saying you're attempting to open an account. Excuse me. So we talked about gifts, selling concessions. So we didn't talk about churning. Churning is excessive in size and frequency of trades. We didn't talk about front running. That's trading ahead of a customer. We didn't talk about opening fictitious accounts. Hopefully, Code of Conduct. There's also code, the COP, the Code of Procedure. So the Code of Procedure is when you hear from FINRA's Department of Enforcement. So the FINRA Department of Enforcement contacts you, you respond with 45 days, COP, right? And the Department of Enforcement can fine you, censor you, expel you, bar you. Stupid but testable. They don't have a badge and a gun. They can't throw you in jail. And now, if you think the Department of Enforcement of FINRA under the Court of Procedure has been unfair, you can appeal that to the National Judiciary Council. I wouldn't be surprised when they uphold the locals, because that's typically what they do. And if you still think you're getting, an unfair deal, you can go to the SEC, and they typically are going to uphold FINRA. Then you can go to the court, or all the way to the Supreme Court if you like, right? Now, sometimes FINRA at the Department of Enforcement will ask you whether you want to admit guilt to a minor offense. And if you'll accept the facts, waive your right of appeal and consent for a minor rule violation, $2,500 might not be a bad idea, right? $2,500 bucks, and everybody gets, back on with their life, right? Now, you can also make your own offer as a responder. You can say, hey, I'd like to make good. Here's what my offer is. If you're going to do that, by the way, you should see what other people have done in a similar situation. That same monetary area for your type of situation. We also have the Code of Arbitration. The Code of Arbitration can be doing, the firm and the customer. The customer has to agree to the process. Now, if the customer doesn't agree to the process, we're not going to open the account. But on the test, make sure you'll see on your exam, the customer has to agree to the arbitration process. Some states require mediation. And if they do, we do mediation before we do litigation or arbitration. We have simplified arbitration for $50,000 or less. And in simplified arbitration, we have one arbitrator, which means it's easier to figure out what's going on. So we don't need to have a hearing. And if we don't have arbitration for our employees, you as an employee or an associated person agree to go to arbitration. The exception would be for HR issues like sexual harassment, things like that. All the decision arbitrations are final and binding. There are no appeals. So remember, you can appeal a code of procedure thing, COP, but not so with the code of arbitration. All right, so the awards must be paid within 30 days, and the statute of limitation for arbitration is 6 years. We have the Patriot Act, the United States Patriot Act, and the Patriot Act is to combat money laundering. So every firm and its WSPs, its written supervisory procedures, has to have a section about how they're going to combat or, do anti-money laundering. So under the Patriot Act, we're going to have a picture ID to open the account so we know who you are and who you claim to be. And the Bank Secrecy Act allows us to file information with FinCEN for currency transactions, receipts. The CTR is for transactions in excess of $10,000. We also file suspicious activity reports for transactions that are commercially illogical. That's like red flags, where, what they're doing makes no economic sense, the origin of the funds, whatever the case may be. And that is for $5,000 or more. We talked about picture ID, and we also have what's called the OFAC, the Office of Foreign Control, to make sure we're not doing business with anybody, that's on a list that, we're not supposed to be doing business with. Like right now, some of the Russian billionaires close to Putin, for example, are on that list. Suitability and risk, we need to, when we are trying to figure out for us to do a good job over time, we need to know a lot about the customer. So when we open the account, we're going to do some data gathering. And we want to know your name, your address. We need your physical address. Now, we will send things to a P.O. box after we open the account, but physical original hard card, we have to have your physical address. We have to have your tax ID number, your social security number. We talked about photo ID. We're not supposed to open accounts for minors directly, and the easiest way to make sure you're not a minor is to ask you your date of birth. Occupation, remember, if you or your spouse are associated with a FINRA member firm, by making written notice to your firm, and I'm gonna follow any special instructions they're gonna give me about opening the account. Accounts are accepted by the principal. So if I have an account, I say it won't be open until I approve it. Any trades done, you better say no, right? It's very important, this information. So we tell the customer, listen, we want to make sure we dotted every I, we crossed every T. Within 30 days, I'm going to send you a copy of the new account form. Could you please look it over and make sure everything's okay? If not, please let us know so we can make a correction. We realize that over time, your investment situation could change. And so we're also going to do that every 36 months just to make sure, there's been no material change. We can also do it annually and do an annual review. Anytime somebody messes with the account or changes something, we'll kick out a copy to you within 30 days. So one thing we want to do in terms of a customer profile is say, hey, listen, why don't I start our relationship here by doing a balance sheet for you? Let me see where you're at, what your net worth is at as of today. And could you tell me about your current assets? Cash or things you plan to get turned into cash in 12 months or less. Could you tell me about your long-term assets? Your house, your car. Let's go over your current liabilities, things you're going to pay 12 months or less. Let's go over your long-term liabilities, debts, the mortgage on the house, car loans, and let's establish, what is your net worth? And, total assets minus total liabilities. And, we can revisit this, and we can revisit this every quarter, once a year, semi-annually, whatever fits best for you. What I'm hoping is what we'll be able to help you, get that number to work in our favor and go up, right? We need to know about your investment experience. We need to know about your investment objective. Are you investing for growth? Are you investing for income, growth and income, total return? How liquid are you? What is your attitude towards risk and reward? It's really this kind of important. This is our first step in terms of suitability and risk. And certainly more often than not, we're going to test you on what will clearly be unsuitable given somebody's investment objectives and current circumstances. Types of risk. So, types of risk, we have credit risk. Credit risk is associated with debt-denominated securities, and that would be the issuer, doesn't pay the interest and principal. And that's one reason, the only bond fund is unlike every bond portfolio. It's unlikely that every bond is going to default. There's credit rate risk. There's a tendency of securities prices to move together. That's called systematic risk. Remember, non-systematic risk is also selection risk. There were 10 equally suitable ideas. I picked one of the 10. The other 9 did fine. The one I picked went under. And the easy way to do that is to diversify. And the easy way to do that is to buy a mutual fund. But remember, risk prevails in a mutual fund despite your diversification. So you're still exposed. You're not exposed to selection risk in a mutual fund, but you are certainly exposed to systematic risk. A purchasing power risk is inflation. The risk that your investment loses value to inflation. That's found in common stock, mutual funds, bonds. We have legislative risks. Legislative risk, Congress changes the rules. For example, the dividend exclusion ratio used to be 70%, now it's 50%. So we have legislative risk. We have call risk. We have, call risk. We talked about that, declining interest rate environment. Remember, if you're a bond fund, the interest rates go up, the NIV is going down. Returns, we said you can have your returns. You're only going to make money one of two ways in investment, either an income stream or asset appreciation, price appreciation. So if there's no income stream, it's going to be price appreciation. And we said if it's price appreciation, watching the NAV of your fund go up and watching your investment go up, that's not taxable. But when the fund manager sells, then that's going to be a capital gains distribution, and that is going to be a taxable event. And that is, it's going to be either be short-term or long-term based on how long the fund has owned the investment. Under 12 months is short-term, over 12 months is a long-term capital gain. Okay, I think that's pretty darn close to our Series 6 in 60 minutes. Thank you so much for sticking this video through. What you're probably going to do next is your 63, and then I'd imagine you're going to do your 65 after that. Remember, I can't discipline you if you haven't already got to this point, and haven't gone through our academy and really prepared for the exam. But let me know what the next leg of your journey is going to be, and let me know if this has been productive for you or not. And we're really looking forward to bringing new people up in this industry. And inch by inch is a cinch. Yard by yard, your Series 6 is hard. Make sure you subscribe to the channel. Reach out if you have any questions. You can contact me through millionairesintraining.com. And I'm just really grateful that I get to be a part of this industry, and that you may have some interest in becoming a broker yourself one day and becoming a part of our great team. So thank you so much, and we will see you in the next installment. Take care. Bye-bye.